In this video, I wanted to talk about tax residency and why it is important. So if you are a remote worker, a digital nomad, if you are an expat who has relocated overseas, if you're a retiree and you've moved overseas because the cost of living in your home country is becoming too much, this is affecting a lot of people. There's a lot of retirees moving overseas. There's a lot more digital nomads and remote workers overseas, working from overseas now than there was sort of 5-10 years ago. And because of this, governments are going to take a bit of a closer look at tax residency. They may want to capture some tax revenue from foreign residents. And we're seeing this in Thailand. They've got their new rules that came out on the 1st of January this year, where foreign sourced income is going to be taxed in a different way than it was in the past. So I think as global mobility and workforce trends have changed, tax residency rules will eventually change to catch up with this change in the way people live and work now. And this has already been slated to happen in Australia. They're bringing in they're looking at bringing in some new tax residency rules. And I think this will happen with other countries around the world as well. Another reason why tax residency is very important is if you are, for example, an Australian and you have property located in Australia, but you don't live in Australia, so you're a non-resident of Australia, depending on your interpretation of your residency and the tax office's interpretation of your residency, whether you're deemed to be a resident or a non-resident, this can have very different impacts on your tax situation if you're looking at offloading a property that you own back in the country. It can make a material difference to your tax liability. So it's very important to get these things right, even more so if you have significant assets that you're looking to sell. So before we get into the rest of it, my name's Aaron, I'm from offshore in Asia. If you're interested in moving to, doing business or investing out in Asia, head over to offshoreinasia.com, have a look around there. You can send us an email, you can book in a consult call, and we can help you to get out here living your life out in Asia. So the whole concept of tax residency, what it is which country has the right to tax you. And there's a couple of things you have to look at here. There will be the domestic rules of the country, either where you come from or where you live or where you hold assets. And there will be a double taxation agreement, a tax treaty, potentially, between those two countries, and that will govern who has the right ultimately to tax you on certain kinds of income and capital. So when you're looking at your tax situation where you may or may not be a resident, yes, you do have to look at what the sort of baseline test is. Do I have to be in the country for 180 days, 183 days, whatever it is around that. But then after that, you need to go look at the double taxation agreement and see what the residency tiebreaker rules are between those two countries. Because if, for example, if you're an Australian citizen and you've lived all your life in Australia and then you've moved to Thailand and you've been living in Thailand for 9 months, both countries are probably going to consider you a tax resident. So ultimately, where you are determined to be a tax resident for final tax purposes, you need to refer to the double taxation agreement for that and the tiebreaker rules to see who will have the right to tax you. Different countries have different rules and different methods for working out whether you're a tax resident or not. So while it is pretty common to have like a sort of a 6-month test based around 180, 183 days around that mark, that's not the only way to trigger residency. For example, you can trigger residency in Malaysia if you've only been there for 90 days in 3 out of the last 4 years. So you've got to be a little bit careful if you are spending decent amounts of time in a country, what their rules are, and then you can plan around that. So you can see here that it is very possible and it is very common to trigger tax residency in more than one country at the same time. Whether these different tax authorities, particularly the country that you have moved to, acts on this and wants to tax you is another matter, but still from a legal standpoint, you still may be a tax resident in 2 countries. Now, if you have business income, this becomes a little bit more complex because then you have to start looking at where is your company registered. The default sort of approach to this is to base a company's residency in the country that it is registered, but then you have to also look at again, the tax treaties and permanent establishment rules, and perhaps controlled foreign company rules. Again, for an Australian example, but you could apply this to many countries. If you are a resident of Australia, but you have a company set up in Hong Kong, then they will want to tax your Hong Kong company at Australian corporate rates. So just having a company registered in an offshore jurisdiction doesn't automatically get you off the hook. You have to be a little bit careful around permanent establishment, controlled foreign corporation, and central management and control rules in the country that you are deemed to be a resident of. So my advice on this is to, especially if you're a digital nomad, an expat, a retiree, a remote worker, any of these kinds of people who've left your country, gone to another country to predominantly base yourself and work out of, be very intentional on the way you set up your lifestyle, how long you're spending in certain countries. Put in a lot of planning around where you're going to incorporate. What are the rules in the country where you're incorporating? What are the rules in the country where you are living? Is there a tax treaty in place that is going to change things? It does get very complex, but it does open up opportunity for tax planning as well. There are some ways of doing things that are better than others. You can cut down your tax bill. It is still very possible. You just have to be mindful of your situation and set up your affairs accordingly. We'll wrap it up there, guys. Just a very quick video here. It's an important topic. It's a pretty boring topic, but it is important, especially with what's going on in Thailand and with, as I said, work and relocation and retirement, expat sort of lifestyle patterns are changing as well. So if you would like some help working through your tax resident situation, either in your home country, in the country where you have relocated to, where your assets are based, where your company is incorporated, if you have any questions around that, if you want to set things up in an tax optimized, efficient manner, we can help you to do these things. So head over to offshoreinasia.com. There's a button up in the top right hand corner. You can book a call there. We can have a chat, start looking at your situation and putting things in place to keep you out of trouble with the tax authorities, keeping you compliant in all the countries that you have financial affairs with, and then you can get on with living your life and not worrying about all this other stuff too much. Thanks a lot for watching, guys. We'll see you later.